Hello and welcome to Portfolio Matters, weekly markets checklist, week 197. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, firstly, a bit of housekeeping. So we're going to return to a bi-weekly schedule from now on. Next one will be in 2 weeks' time, sometime during the week when I get back from holiday. Okay, news this week. Well, the US government shut down. The Senate failed to agree budget. We have a section coming up on exactly what's happened. But essentially, the Republicans' proposed budget did not include any Democratic input, and the Democrats are concerned about the expiry of enhanced tax credits for healthcare insurance that were created under Obamacare, and the Republicans essentially are trying to dismantle Obamacare. The US Supreme Court has allowed Lisa Cook to remain as a Fed governor. They will hear the first oral arguments in the Trump's case to dismiss her starting in January. The Tory party is having an outbreak of fiscal conservatism, which we very much welcome. They're saying that they will impose £74 billion worth of cuts if they get back into office, which seems very unlikely, by cutting welfare and slashing the size of the civil service. Overnight, Japan has elected the Iron Lady, Sanai Takakashi, he says. The topics rose, 30-year bond yields rose sharply. The yen fell as markets expect that she will increase fiscal spending and keep pressure on the Bank of Japan to keep interest rates low. That doesn't sound very much like our Iron Lady, actually. And finally, OPEC Plus are going to open the taps again in November, raising quotas by a further 137K. Oil rose slightly in relief. It wasn't even worse, but oil has had a terrible week. We will take you through the data in due course. Economic news. Well, there's very little economic news this week because the US government shutdown has meant that the release of the non-farm payrolls data, which was due out last Friday, has been delayed. But we had the ADP private sector employment data, and that was poor. That missed target and was negative for the second month in a row. And that confirms that US labour market is slowing. UK PMIs were revised sharply lower, particularly the services PMI, and the composite was revised down to 50.1 in September, i.e. barely growing at all. EU inflation numbers, the flash estimate for September was in line with expectations at 2.2. That was a rise. Core was flat at 2.3. Markets news, well, gold and silver continue to shine. Richard will look happy in a second. Equities continue to climb. Oil had a very bad week. So this is Japan's Iron Lady. The topics had a good day, up 3%. The yen's falling, bond yield, 30-year bond yields rising.
It's a beautifully coloured suit that she's wearing, isn't it?
Yes.
I love that deep blue.
Yes. I'm not sure that increasing the fiscal deficit even further is like our definition of deep blue conservatism, but there you go.
No, she might be iron, but she's not iron in the way that Margaret was, that's for sure.
Yeah. Now, after the ADP numbers, markets are putting a 96% probability that the Fed will cut rates later this month. The US labor market is slowing. Betting markets are expecting that the US government shutdown will last. They're saying at least 2 weeks. The maximum probability is on it lasting more than 2 weeks. And when you look at history, it can last quite a long time. Under Obama, it had 35 days. I was listening to the Rest is Politics US yesterday, and they were saying that they're expecting the Democrats to back down because essentially the Democrats have not got their narrative right, and Trump is winning the propaganda war.
Yeah.
Now, during a lockdown, the majority of federal workers keep working, but many do so without pay. Nearly 900,000 workers could be directly furloughed this time, while millions more are forced to work without pay. They will get paid eventually, but short term, they don't get paid. Obviously, Trump is also threatening to lay off lots of federal workers permanently, but so far he has not done that. Now, OPEC Plus met and agreed to increase quotas again in November by 140,000 barrels a day. Reminder, actually, only the Saudi and the UAE probably have excess capacity to increase production, but this is the latest forecast from S&P Platts, and you'll see that they are forecasting the oil market to be systematically oversupplied in the coming year. That is unlikely to be good for the oil price. And finally, a bit of good news. So this is cocoa prices. And we've talked about this before, how the sustained rise in cocoa prices has been due to drought in Ghana and the Ivory Coast, where the price signal doesn't get through to farmers because the farmers sell to the National Marketing Board, who had sold cocoa forward when it was cheap, and then they weren't passing higher prices on to the farmers. Well, apparently, farmers are now getting higher prices, and that should mean they release stocks and start to boost supply. Okay, now on to the reasons for the US government shutdown. So in 2012, Obama passed the Affordable Care Act, which Republicans have labeled Obamacare, and that aims to expand and reform private healthcare insurance in the US. I'm not going to go through this in detail. Please pause and have a read. The bottom line is that it subsidized health insurance for poorer people and therefore gave them access to healthcare. Now, that is due to expire at the end of this year. And the tax credits allow around 24 million people to get cheaper healthcare. And so that's only about 7% of the population, but it includes those people who don't work for big corporations, basically, like small business owners, farmers, and ranchers who are largely self-employed. And if that tax credit expires, they will see their premiums rise by an average of 114%. So this is quite a politically important group who will see massive rises in their healthcare insurance, and they will be deeply unhappy. The Congressional Budget Office estimates about 4 million people would lose their coverage if the tax credits expire. But the CBO estimates the cost of extending it would be 350 billion over the next 10 years. So that is the source of the fight. The Rest is Politics US was saying they expect the Democrats to back down because the Republicans are portraying their efforts to close the government as because of trying to get healthcare insurance for illegal immigrants rather than this group of small business owners, etc. Let's see what happens. And on to equities. Richard.
Thank you very much, Keith. So last week, there was generally a good market for equities. FTSE All World up 1.4, All Share up 2.2, Stocks Europe up 2.7. Europe's been outperforming the US for quite a long time now. S&P up 1.1, Russell up 1.7, Nasdaq at 1.3, Hang Seng up 1.2, Topics up 3.3, and then Bitcoin had a good week, up 10% on the week. The dollar, a pound, and euro didn't really move very much at all.
Yeah.
So we have the FTSE All World Equity Index.
Yeah, just continuing to climb.
Yeah. The All Share Index.
Good week.
Stocks Europe. It's Euro Stock 600.
Yeah, after a long flat period, it had a good week.
Yeah. S&P 500. Nasdaq Composite. Russell 2000. Hang Seng up 34% year to date.
Absolutely amazing. You'll notice the US markets have been singly unaffected by the government shutdown.
They're unaffected by anything, Keith, aren't they?
Yeah, that's true.
Extraordinary. Topics. As Bitcoin.
Yeah, Bitcoin ignoring our piece last week on, Bitcoin treasury companies.
Flirting with an all-time high.
Yeah.
Maybe it's flirted with it. I don't know. And the pound against dollar, which has been flat, pretty much flat now for 4 months, 5 months. The euro against the dollar, which sort of flattened off, hasn't it, over the last 3 months. And the dollar index, which has done the opposite. Well, it's flattened off over the last 3 months or so. And there's the VIX, which at 16.6 is pretty low and staying low. S&P 500 price to peak earnings ratio, 27.7, so very close to the high of 1999, and way above the historical mean. This is the Kate ratio versus the historical average, which everybody is always saying is completely out of whack, and there it is, completely out of whack. But it doesn't seem to matter. And I think it doesn't matter because of effectively the amount of money printing that is going on. So this is the Buffett indicator US stock market value to GDP. And that also is out of whack. So I'm minded, Keith, of what the stock market did in Germany during the period of hyperinflation.
Yeah.
And, it carried on going up exponentially. And the people who were invested in the stock market still lost money mostly. And the only way to hold the value was to own physical assets, really, or shares in physical assets. So
that's true.
I'm minded. I think that the Fed's going to have to start doing QE again at some point fairly soon, and I think that because I think that's the only way it's going to be able to manage the interest rates. And I think that the US government, the plunge protection team, they can't afford for the stock market to fall because tax receipts will drop.
That's true.
And it's the market that is maintaining the appearance of a growing US economy. Now, I may be completely wrong, but that's my sense at the moment.
Well, the thing is, Richard, the thing about Weimar was there was uncontrolled money printing and inflation just absolutely took off. Now, in the case of the US, if there's a return to QE, then you may be right about uncontrolled money printing, but inflation is not out of control. Inflation, it is picking up. There's no question about that, but it would seem to be, I think that will be temporary and it's not that high. So we're talking about 2.7% on the CPI.
Yeah.
It's not huge.
No, I agree with you, Keith. I think I completely agree with what you say. I think more I'm sort of saying that whilst everybody looks at these numbers, us included, and says, the market is too high, it's going to crash, there are some good reasons around why it won't crash.
Well, yeah, I've got it totally wrong. The money debasement trade has been absolutely fantastic. Gold, equities, all doing well. But the thing is, ultimately, it's a function of inflation and what your future return on stocks will be. And the thing is, when the dividend yield and the earnings yield, as this rises, just keeps on falling, and you can get higher returns from investing in, if your bond yields are risk-free in theory, um, and at some stage value will come back into fashion. And I think that, what's driving this market now is fear of missing out. So I had my weekly call with the US fund manager
Oh,
last
yeah.
week, and he was saying that, he had been out with a group of friends and he was astonished by what they were all up to in the stock market.
Right.
And he was talking about an ophthalmologist who was selling puts, okay,
Right.
making extraordinary amounts of money because you've seen that VIX is low. Well, actual realized VIX is even lower. Okay, so this is it's just a guaranteed way to make money, but it's like picking up pennies in front of the steamroller because at some stage
Yeah.
you're going to have pickup involved. And it reminded me of, and I was trying to find this story this morning, but I couldn't find it. But I'm sure that in the 1987 crash, NatWest got caught out because some of its traders, like a graduate on the scheme, was selling puts. And this has been a great way of making money while the market was rising relentlessly. And then, of course, it fell 25% in a day.
Massive exposure.
And he got absolutely taken out.
Yeah. I mean, yeah, I mean, you're right. The whole thing is irrational. And I also, the valuation of AI shares is irrational. Of course, if you take those out of the equation,
Yeah,
then the market is not as nearly
that's true.
overvalued as it appears to be. And it may
Absolutely.
be what actually happens is the AI shares effectively get taken out of the equation by that bubble popping.
Yeah. Yeah. Well, been saying it for a long time, wrongly, but
Ever since we started, I think, 197 episodes we've been
Yes,
saying.
exactly. So, I mean, but the thing is, eventually, it's to me, it's like .com, it keeps on going up until it doesn't.
Yeah,
And so you either get in early or you don't get in, full stop. And
yeah,
I'm of the don't get in. Now is the worst time to get in.
I completely agree. Yeah. Okay, so foreigners now own 20 trillion of US equities. Apparently, they own 30% of the US stock market.
Yeah, that's it. You see, it's been a worldwide bubble, basically. So the US stock market, as it rises, is sucking in capital from all around the world.
Retail has fear of missing out.
Yeah. So retail volume, trade volumes, and
Yeah,
this is, corroborating what my
yeah,
friend in the US was saying, that everyone is dabbling in the stock market.
yeah.
It reminds me of the old Joe Kennedy saw about the 1929 stock market crash, where, he goes to have his shoes shined, and the shoe shine boy
Yes,
is
that's
asking
right.
for
Yeah,
tips, and he said, right, that's it.
that's
If the
it.
shoe shine boy is in the market, then where's the extra money going to come from?
Call options surge to record highs. That's a big, big surge. This is also to do with these 0-day options, isn't it?
Yeah.
Which I think, well,
Yeah.
I'm just, I have nothing coherent to say on that subject other than it feels completely bonkers.
Yeah, well, you and me both, mate.
S&P dividend growth has outstripped inflation since the 1950s by a lot. Interesting.
Yeah, I was amazed by this, actually.
Yeah.
Absolutely amazed. I've got the thing is, what is that something like 90% of stocks that come onto the market disappear again,
Yes.
which means that the survivors are incredibly successful, and you have to be prepared to rotate out of your losers into the winners, and that's essentially what the S&P 500 does.
Yes.
If
Yes,
it
that's very true.
Yeah, if you it cuts stocks that have
Yeah.
fallen out and
Yeah.
puts in the new ones,
Yeah.
and in your portfolio you have to be prepared to do the same.
And there is an expectation in the market that corporate profit margins will keep on rising. There's a bit in the FT this morning, wasn't there, Kit? And you saw it saying that companies now starting to pass on to consumers the tariff increases, tariff costs.
I haven't read it this morning because I've been preparing PM, but yeah.
That's right, Keith. I was just idling my time away. 2026 earnings forecast for the Mag 7 are improving, but not for the rest of the market. I mean, they may do, but I still struggle. I struggle with earnings for the Mag 7. I don't quite know where they're going to come from.
Yeah. Each other, I think.
Actually. Well, there is that, isn't there? There is there is some talk of that. Is it the snake eating its tail, isn't there? Investing when the market is at an all-time high has been a smart strategy. It is from 1988. Gosh, from 1988. But you've also had to get out at the right time, surely.
Yeah, getting out at the wrong time. It's been disastrous. Anyway, moving swiftly on.
Yes. We're not advocating this, by the way.
Yeah.
So this is the market cycle with investor sentiment, and we have, as it says at the side, been in euphoria for quite a long time now.
Yeah, I like buying here. That is where we're going to be, again.
Yes, one day.
Investing is a long game, just I've fucked it up the last couple of years doesn't mean that I'm out of it.
It's a nice little graph, that, isn't it?
Yeah.
Unprofitable tech is a trade du jour because they have great growth prospects.
Yes. Now look at that, though. Yeah.
Yeah. And October historically very volatile, and we are in October. And you can see that there tends to be a significant fall in the month of October. A significant increase in volatility.
Yes.
And November and December traditionally good for stocks.
Yeah.
There we are.
Okay, thank you, Richard. On to commodities and quick summary. Well, energy generally weak. Oil was down heavily. Industrial metals generally strong, particularly copper, which had a bounce, and tin. Precious metals, another strong week for gold and silver. Platinum group metals are having a pause after a very strong run. Okay, on to energy markets. Well, Brent was down 6.3%. WTI down 11.5%, both of them down 10% on the year. Natural gas futures in the EU down 4.3%. Great news. It is getting cold. Turn the central heating on, but gas prices coming down. That's fantastic news. In the US, natural gas futures rose because of a forecast cold snap and a cold winter. Coal down a bit, down 16% on the year. Uranium down 1.8% over the past week, still up 11% on the year. This is Brent. So having recovered a bit, sharp sell-off this week. WTI, even worse, now down 13%, actually 14% on the year. Numbers specific to the oil market. So these numbers have been updated. The EIA continues to work despite the government shutdown. And so over the past week, we've had further crude builds in the US of best part of 7 million barrels a day. US crude oil production was flat at 13.5 million barrels a day, and that is pretty flat on the year, frankly, despite the fact the Baker Hughes rig count is down very substantially, down by about 15% on the year. So that would imply that you'd continue to get good productivity growth in the US shale patch. And frankly, I don't think anyone was expecting this, that US oil production would rise back up given the fall in the rig count.
Yeah, that's curious, isn't it?
Yeah. And reminder, we report the price of oil in nominal terms. All our charts use the nominal price, but of course, in the past 5 years, prices are up by the price index is up by about 25%. And when you compare 66 barrels a day, in purchasing power, inflation adjusted terms, that's $50, 2020. So oil is cheap. Natural gas futures, that's great. That is fantastic. Getting into October, compare it with last year, you are 50, a third down. This is the UK, similar story. 20% down, brilliant. US natural gas futures rising again. Of course, returning to the UK, you see that actually between the second and third quarters, the price of natural gas fell in the UK, but the Ofgem energy price cap rose because of green subsidies. So will the lower gas prices feed through to lower bills? Question mark. This is coal. It's found a bottom, I think you can say. Uranium taking a bit. On to industrial metals, Richard.
Thanks, Keith. So for the week, aluminium was up 1.8%, cobalt unchanged. Copper was up nearly 6% and 26% on the year. Iron ore pretty much unchanged on the year, not much movement on the week. Lithium carbonate, likewise. Neodymium, no change on the week, but up nearly 60% on the year. Nickel up 1.2%, unchanged on the year. Tin up 7% and up 27% on the year, and zinc up 4% for the week, but only up 1.5% for the year.
Yeah, the Chinese PMIs were quite strong. Seemed to be indicators of recovery in Chinese manufacturing.
So we have aluminium, cobalt, copper.
Yeah, nice looking chart.
Yeah. Iron ore, lithium, neodymium, nickel, tin.
Yeah, the bull market in tin is back on. Reminder, tin is actually quite rare in the Earth's crust. It's a rare element and it's essential to electronics.
Yeah. Zinc, which is having a nice run up since the early summer. And moving on to precious metals. As Keith said, another good week for gold and silver, up 3% and 1.7% for the week respectively, and 50% and 68% for the year respectively. Platinum and rhodium not really very much changed, but up 80% and 54% for the year respectively, and palladium down 3% for the week and up 42% for the year to date. So still progressing quite strongly. There's gold, silver, platinum. So the interesting thing about platinum is that typically it shadows the price of gold approximately, but at the moment it's less than half the price of gold. Rhodium and palladium.
Thank you, Richard. On to rates. Not much change, sadly. So the UK budget is coming up next month, and hopefully we'll see an outbreak of fiscal conservatism, fiscal prudence, and that should help bring UK rates down. And the Bank of England is forecasting that UK inflation will peak at 4% in September. So the data for that should come out this month, and thereafter we are hoping that UK inflation will come down. The Bank of England, one of the Bank of England governors last week was talking about how the Bank of England faces a delicate balancing act by attempting to get inflation under control without killing the economy. And the danger was they keep interest rates too high for too long, and the UK economy slows even further. Now, so the bias is towards cutting if the economy slows further. This is the US, not great, not good, rates not coming down. Reminder, in the US, QT continues but has slowed, and we seem to have, on Richard's point about money printing, the size of the Fed balance sheet, it's expanded a lot. The chance of it coming right back down to normal, lower levels, I'd think is very low. So we've done some permanent money printing, basically. But, the central banks have been cutting rates apace since 2022. It's just long bond yields have not come down. So this is the UK 2-year, 4%. Market expecting UK interest rates to average 4% over the next couple of years. 10-year, the best you can say is it hasn't got any worse, not coming down. 30-year, not sure that we're out of the woods yet, frankly. That looks like an arc. US 10-year, well, actually, we do seem to have peaked. German 10-year, topping formation, not sure. France, down from recent highs, but you see the socialists are threatening to try and get rid of Nicolas Macron's latest prime minister. The crisis in France is not going away. Italy, doing much better than France. Greece, stable. Japan, this is as of last night. It's changed this morning. It's spiked. It's spiked by about 13 basis points on the election of the new prime minister.
So, okay, so back where it was, really.
Yeah. And on to this week's economic data. No change, really. UK stagnation, inflation rising. Inflation should peak in September. Economy just growing at 1.4% per annum. Not great. EU stagnation. US fine, but the labour market is definitely softening. China stagnation. Okay, on to the UK, Richard.
Thanks, Keith. Okay, so Bank of England consumer credit for the month of August is 6.9 billion, so pretty stable, actually.
Yeah, that was a good number.
And UK net mortgage lending, 4.3 billion, again, fairly steady at the sort of long-term average.
Yeah, absolutely. Honestly, amazing. Because interest rates, back here, interest rates were basically zero, very low. And now we've got interest rates of 4%. So mortgage rates of like 4.5%, 5%. And you're getting a lot of mortgage lending. I just don't understand the UK housing market. How are people affording that?
No, I agree. It's a bit of a conundrum, isn't it? Net lending to individuals at 6 billion. So that is, if you call lending healthy, that's a healthy level of net lending.
Yep. So another way of looking at this is that, rises in UK interest rates don't really seem to have had that much effect on people's propensity to borrow.
It may be that the increase hasn't actually really been enough. I mean, I'm not suggesting it should go higher, but it may just be that it hasn't crossed the threshold that people are having to start really changing their behaviour.
Yeah.
UK M4 money supply growth, 0.4% in August, which is quite high.
Yeah.
Business investment, quarter on quarter, -1%. And year on year up 3%. So a bad quarter, actually.
Yeah. Labour government, pro-growth policies. There you go.
Yeah. UK GDP quarter on quarter was 0.3% and year on year is 1.4%. So those numbers are consistent with each other.
Yeah, but actually we have strung together 6 quarters of
some sort of positive growth. Yeah.
Hurrah.
Although productivity isn't growing, is it? Which is what we really need to happen.
Yeah. True, Richard. But why spoil this party?
Sorry.
I was being briefly positive then.
You were. I'm sorry to have spoiled it. UK services PMI 50.8 below expectations, and quite a big drop.
Yeah. So this is the revision. Previously, we'd reported 51.9, which was itself a drop, and they've revised it even lower. Now, historically, the service PMI has averaged around 54, 55. So this is well below average.
It's not what Rachel Reeves would like to see.
No.
And the composite PMI 50.1, looking a bit like the services PMI.
Yeah.
Quite hard.
Not great.
So house prices month on month in September up 0.5% and year on year 2.2%. Actually, both of those are higher than expected.
Yeah. Amazing. How people affording it. It just mystifies me.
I think part of the issue is a housing shortage, isn't it? Of course, so everybody gets squeezed. Everything gets squeezed up.
So I was reading on this, Richard, and when you look at the increase in population, we've actually built enough houses to accommodate the increase in population. I think the fundamental problem in the UK is that we've always had quite a lot of empty buildings, and B, that it's fundamentally misallocated, so that families whose children have left home, they are incentivized to stay occupying their big house with lots of empty bedrooms, whereas young families young families are kept out.
Yeah.
So if we change the tax system, we'd fix the problem.
More stamp duty would fix it, I think, Keith.
Yeah. Is that your bid for the premiership of the Labour Party, Richard?
Yeah, I just think we should increase stamp duty. It has such a beneficial effect on the property market.
Yeah, mind you, it was George Osborne who really put it up.
Idiot. It was.
Yeah, that was concerning.
I can't remember George Osborne's middle name.
Yeah, idiot, I think it might be.
So apparently he's now banging the drum for crypto, which I think is the right thing to do, actually. In other words, so the UK doesn't get left behind in financial innovation. It's the only good thing he's done in 20 odd years.
Okay. Okay, so every month the Bank of England surveys businesses, and they put out initially that the result was 3.5%, and then about an hour later they revised it to 3.4%. So this is essentially a comment on the state of UK statistics.
Yeah.
Who knows?
Not great, is it?
Not great. But they're, expecting inflation to come down a bit in the current year, but not much.
But still over 3%.
Still, over 3%. And, the Bank of England, that's way above the 2% target. And the Bank of England has been cutting rates for a while now,
And it's still not working.
Yeah.
Economic surprise index is, you can see for yourselves where it is.
Yeah, noisy. Yeah, it's like somebody having a heart attack.
Yes, like me on a running machine. Indeed, job postings index definitely has, the decline definitely seems to have leveled off.
Yeah, I'd definitely say that. I'd say actually that looks like it might be bottoming, despite everything that PMIs, etc. is certainly not deteriorating.
And this is a storm Amy, which is a US hurricane, wasn't it? It came across, I believe, produced a huge surge in UK wind power generation on Friday and Saturday. So 73.6% was renewable, only 12% fossil fuels. Fantastic. Yeah,
but we were still using fossil fuels, despite the fact we were generating vast amounts of wind energy, because we couldn't get the electricity to the right place. So you'll see the UK electricity price actually dipped negative.
So there's a lot of wind power produced in Scotland, isn't there? And they haven't got the connections to take it down to the south, to the Midlands, for example, where it can actually be used.
Precisely, and loads of NIMBYism is stopping us building pylons to move the electricity south.
And presumably they feather the windmills, don't they, the turbines, so that they don't produce power.
Mm,
And then they sort of
presumably.
calculate what the power would have been.
Yeah,
Some excess energy was transported to the continent.
yeah. But again, the problem is, most of the connectors are down south.
Yeah,
So, unless we build a connector direct from,
yeah,
Scotland to Denmark, we're not going to
yeah.
be able to export it all.
And Oman in 2025 is a bigger market for IPOs than London. I mean, London is really struggling. So the goose that laid the golden egg has been killed by regulators, in my view.
Totally agree.
And
And we've done a big segment on this a while ago about how UK economic growth essentially is dying because we've overregulated the banks.
yeah,
And so banks don't lend to small businesses. Who lends to small businesses to fund growing small companies?
did you see the article by Andrew Bailey in the FT on stablecoins?
I did.
I
It did
thought it
not
was
warm my heart.
I thought it was incoherent.
Yeah.
I just didn't seem to understand what he was talking about. I was shocked at how bad it was.
Mm. Yes. Very little in this about this country shocks me anymore, Richard. It's like, yeah, anyway.
But I was shocked by his apparent lack of understanding. There was some comment in the letters afterwards, but I was shocked by his apparent sort of inability to grasp what's going on, and in his pedestrian sort of nature.
Yeah. Is this your bid for governorship of the Bank of England, Richard? You could do a
Mr.
better
Keith,
job on stable
well, you
coins.
see, what I would do if I was governor of the Bank of England is I would disestablish it. I would disestablish it, and then everyone would be made redundant, and the country would be functioning much better without it.
Really?
Yeah.
So you would move to an Austrian school of interest rates being set by the market.
Absolutely, yeah.
Hmm. Interesting.
So there we are. In summary, the UK economy is losing momentum according to PMI data, GDP, especially with the demands of Rachel Reeves for more tax on the economy.
Yeah.
And there we are.
In summary, there we are. Right, on to the EU. So inflation in September, we've had the flash numbers, 0.1% month on month, in line with expectations and same as August. But because of the window over the past year, the inflation actually ticked up to 2.2% year on year. Really not much of a problem. Core flat at 2.3 and coming down slowly. That inflation in the EU really does not look like a problem. Producer price inflation for September down 0.3% month on month. That was, I'd say, better than expectations, which is flat. So year on year, down 0.6. Now we think PPI leads CPI by about a month. So EU inflation coming down, question mark. Economics. These are all the Eurostat surveys for September. Economic sentiment, flat. Industrial sentiment, flat, but not very good. Services sentiment, flat, going nowhere. Consumer confidence, flat, not very good. Consumer inflation expectations, flattish, elevated. Citigroup Economic Surprise Index fading a bit. German Indeed Job Postings Index had a bounce, and that bounce now appears to be heading back down, question mark. France just heading down. German unemployment rising.
There's a lot of very negative comment on the German economy around, isn't there?
Well,
I don't know how valid it is.
I think they need to start putting all these unemployment people back into the army. It's worked before. Moving swiftly on.
Define words.
Yeah. EU summary, stagnation, right? Onto the US.
Don't take that bit out, Keith.
Right.
Rob will have the Israeli intelligence services after us. US jobs openings 7.2 million, but in line with expectations and fairly flat.
Yeah, I'd say that looks like it's bottoming, wouldn't you?
Yeah,
Like,
I would say so at the moment, definitely. The quits rate is likewise, it looks like it's probably bottomed, although it's hard to tell, isn't it? It's down again a bit, but it's not below the low.
Yeah.
And jobs openings, government job openings continuing to fall, which hardly a surprise, is it? Because what Trump's trying to achieve.
Absolutely. And government shutdown's not going to help.
No.
So these numbers are for August,
And there's been a significant fall in construction sector jobs.
Now I found this really interesting because I've been talking about this like relentlessly for months. But the way a recession works, yet falls in construction and manufacturing jobs, and look at this. That's exactly what you're getting.
Yeah.
So.
Yeah. So it's the exactly, it's the property market actually finally slowing down in the US. The layoff rate remains low, but it's sort of very gently rising. Hiring rate is slowly, gently falling.
Yeah, exactly. So it's just basically a slow slowdown.
Yeah. And there are more unemployed workers than job openings for the second month running.
So the economist Connor Sen has suggested that when unemployment passes a certain threshold, that companies feel more confident in laying off workers because they know that they can rehire them. I mean, the story of the last few years has been labor hoarding, and companies, when they feel confident that they can rehire, they would stop hoarding and lay more people off. And so Guy Berger has done this analysis of the last couple of recessions, and he thinks you're looking at the orange line here and the right-hand axis. He thinks that threshold is about 5%. Okay. Now, the US unemployment rate is currently 4.3%. So rising a bit, it's been rising steadily, but we are some way from the threshold at which layoffs would accelerate. Richard.
Thank you, Keith. That's interesting. So the ADP employment change minus 32K. So that is a fall. And that is a bit of a trend. Well, it's continuing a trend rate that has been dotting around the 0 point for the last few months.
But you notice Trump came in last November, or it's like January. Since then, there has been a very clear deterioration in private sector payrolls. And you'll notice the August number was revised down very heavily from plus 54 to minus 3.
Yeah. Yes, that's so that's another indication US market. The US might be slowing down. And do you want to do this one as well, Keith?
Yeah. So when you look at different measures of private sector payroll growth, I mean, they're noisy. They don't necessarily agree with each other. So Revelio uses LinkedIn data, and it says actually the jobs market isn't deteriorating. Both the non-farm payrolls and the ADP uses actual payroll company data from actual companies, are saying it is. So there is there's a margin of error. And so not to take any one data point as gospel, frankly. And this is them individually. So the BLS, non-farm payrolls, you're clearly seeing a downtrend, but it's saying payroll growth was positive as of August. ADP saying it's now dipping negative. Revelio, which used LinkedIn data, saying that actually it's not negative at all. So, who knows?
So Paychecks index small business employment dipped below 100 in September. So that's a downtrend.
Yeah, that's real payrolls data from small companies in the US. And that again confirms slowing labor market.
Yeah. And US consumers are still pessimistic about their future job prospects, which probably makes the job market quite sticky. People will want to leave their jobs without being clear they've got another one to go to.
Yeah, and so hence you see the quits rate falling.
Yeah.
So the Capital Economics estimate that the Conference Board Jobs Index, and reminder that is the number of respondents saying jobs are hard to get minus the number saying they are easy to get. And that is the blue line. They're saying, and it's rising. So respondents, consumers are saying that the labor market is weakening. They're saying that leads the unemployment rate by 2 months. And so if that relationship holds, and frankly, it's been rising more than the unemployment rate, then you'd expect the unemployment rate to keep on deteriorating. Bottom line.
Yeah. Right. So non-farm payrolls and below 100,000 is a good predictor of a coming recession. So
Yeah.
are we moving into that? It's quite a steep fall off, isn't it? We've got here.
Well, the thing is, what you notice, it tends to accelerate.
Yeah.
So when we were talking about that earlier, when the labor market tilts in the favor of employers, they start to lay people off. And so we've not got to the acceleration yet, but a recession is a negative feedback loop.
And it's heading down quite fast. So
Yeah.
US challenger job cuts, 54,000 in September, which is actually a lot less than expected.
Yeah, as yet, no acceleration in layoffs.
Yeah. The ISM manufacturing PMI was 49.1. The services PMI was 50, which is at the bottom end of its recent couple of year-long range.
Yeah, that's poor. But reminder yet again that there's very little relationship seemingly between this PMIs and actual economic data.
The consumer confidence, 94.2. That's in a general slow downtrend. And the Michigan Consumer Sentiment Index at 55.1 is actually in the bottom percentile of since it's started doing this data series in 1952.
Yeah. I think it's not just talking about the economic sentiment. So consumer sentiment index doesn't just look at the economy. It's just how they're feeling about the world and their country. And it ain't going well in the US.
It's not, is it? No. Case Shiller, month on month is 0.3% in July and year on year 1.8%.
Yeah. House prices coming down in the US.
Yeah, maybe at long last. Initial jobless claims.
So no data. There's no data.
Yeah. Indeed, job postings are still on a downtrend there.
Yeah, in direct contradiction to the JOLTS data.
Yes. And link up jobs postings are also falling again. The Dallas Fed weekly economic GDP estimate is 2.4%.
Yeah, decent.
Fine. Yeah. The Atlanta is 3.8%. The New York is 2.35%.
Yeah, decent.
And the St. Louis is 0.18%, but that seems to be low. It was low last week, it's low this week.
Yeah.
The Citigroup Economics Price Index is low, and US Trueflation 2.2%.
Yeah, not going up actually. So it's quiescent.
Yeah. So last week, we reported US GDP growth quarter two was revised up to 3.8%. which was driven by a rise in net exports of 4.8%.
Yeah.
And a significant fall in private inventories.
Yeah, so basically there are big things going on in some categories, which are distortions from the trade, the
Yeah,
tariff trade. So, it's all a bit misleading. We had negative GDP growth in Q1 and then this big bump back in Q2. Neither of them
yeah,
are quite right.
yeah. And this is a real GDP growth as it's affected by AI. The AI tech boom and contribution from tech capex is frankly enormous. And this shows the spending by the capital expenditure by the Alphabet, Amazon, Microsoft, and Meta, which again are huge. And at some point they're going to run out. Some of them are going to run out of money. I think Meta is most likely to run out of money.
Yeah, well, these forecasts are quite bullish. I mean, just relentlessly increased capex in AI, and you think, well, really, that seems optimistic. But also, contribution to GDP depends on the change, and the max is here, 2025.
Yeah.
So,
And as we've discussed, there's a question of what return they will be able to get on this investment. And at some point,
yeah. Well, the point is on the profitability of these big superscalers. They used to be asset light, and now they're going to be asset intensive.
that's a very good point, Keith. So
So
their entire cost structure has changed.
yeah, the return on capital employed is just undergoing a fundamental negative change.
Yeah, it's a very good point. So the AI infrastructure boom is highly dependent on investor confidence on investors putting more money in to
Yeah.
the system.
Yeah.
And I don't think that's necessarily a given.
Well, if these things tend to come to a sudden stop.
Yeah. So this is the ISM services prices paid and supercore PCE inflation, which show strong correlation, don't they?
Yeah, sadly they do. So reminder, supercore is services inflation ex housing.
Yeah.
Yeah.
So this is suggesting that supercore is likely to go up.
Yeah. Yeah. I think that's fair.
And internet searches for second job have just hit an all-time high, which suggests that the US consumer is indeed feeling the pinch.
Yeah.
And we sort of know they're feeling the pinch, given that is it 90% of consumer spending comes from the top 10% of the population.
Yeah.
Some
Well,
enormous.
50%. 50%.
Some, it's, some totally skewed. And that's what I don't really understand about why Trump wants to change these provisions of Obamacare, because it hits the poorest people. And it seems to make no sense whatsoever, unless it's just some sort of weird retribution that he's after.
Well, I mean, I don't know, it pleases his base, doesn't it? The base likes the way they put it was Trump is fiscally liberal and socially conservative, whereas Wall Street is socially liberal and fiscally conservative.
Yeah.
So in terms of like social conservatism, he likes the poor to be forced back to work and not to get subsidies, etc.
So net savings as a percentage of gross national income is as near as damn it at zero.
Yeah,
Look
I
at
didn't.
Look at that line.
I saw this. Sorry.
No, I was saying, look at that graph down from 13% in a pretty steady long-term decline.
So I didn't quite know what to make of this. It suggests that the economy is just living beyond its means. But if anyone has any comments on this, the way to interpret this, please can they get in touch? Because clearly you've had, the last time this happened was during the GFC, where yes, you are dissaving to boost the economy.
There's also the question of how are savings defined, isn't there, Keith?
Yeah. Well, that is a worrying chart. You need savings to fund investment.
So, in summary, the US labour market looks like it might finally be slowing.
Yeah. But the economy itself is just, ticking along.
Yeah.
Question is, how long can it tick along on AI investment?
Yes.
And onto one chart. Basically, I've stopped doing China. It was like we
We
never
should
believed.
we
Go
should ask ChatGPT that question.
Yeah, that's a good point.
How long?
Actually, on that Chat GPT. Okay, so I everyone knows I'm a runner, and I bought this new heart rate monitor band thing, and I asked Chat GPT, is it compatible with my watch? And I fed in, the new details of my watch. Came back, yes, la di da, this is how you do it. Bought the heart rate monitor. It wasn't. Asked it again, asked it like in different ways, and finally it came up with no, it's not.
No, it's
Basically,
not.
my watch is too old. The technology's changed.
So,
Next
was it
time, like,
hallucinating?
it's just who knows? It was just rubbish.
It's
So I had to
rubbish.
send it all back. No,
Yeah, I mean,
my experience. Yeah,
there is increasingly you come across articles, commentary that says AI doesn't really do what it says on the tin at the moment.
yeah. I think a lot depends on how you ask the question. It's just I don't know. It was rubbish.
Yeah, what you use it for, I think.
Yeah. Onto one chart. It's like listening to this podcast. It's basically modern life is rubbish. It's like I think you might be getting old, Richard. Anyway, one chart. So, um, as Richard was saying earlier, the US, and we've talked about before, the US economy is increasingly dependent on the equity market. When you look at equities as a percentage of US household assets, it's astonishing. Yeah.
Yeah, it is, isn't it? I mean, it's yeah,
So
and
85%, that's amazing.
basically, I mean, it only goes from 1989, but in 1989 it was 55%. So
Yeah.
it's
Yeah. This is out of control, frankly.
yeah,
You can get to 100%, but that's it. You know, and already that's an astonishing number and means the US households, their feeling of well-being, financial well-being, is hugely dependent on the stock market.
yeah,
Okay, big section coming up. So in my call with my US fund manager friend last week, he was talking about um, problems in private credit caused by the bankruptcy of two US companies, Tricolor and First Brands. And I also saw that Jim Chanos was saying that um, he thought they were harbingers of further problems in private credit, and private credit had grown too big. So we're going to go through this in some detail. And because I know we've got some students watching, I'm going to be going into some detail about asset-backed securities, etc. So, had two recent bankruptcies in the US, which have forced multi-billion-dollar losses on private credit lenders. Now, reminder, private credit markets have grown over the past few years as banks have stepped back from lending to companies. So the two companies involved were Tricolor, which was a provider of subprime auto loans, particularly to the Hispanic community, and that funded itself through asset-backed securitizations. And it's alleged to have been fraudulently double pledging collateral in those asset-backed securitizations. We'll go into it. First Brands was an auto parts supplier which funded itself through factoring and reverse factoring, and it is alleged to disguise the scale of its indebtedness through the use of special purpose vehicles. Haven't heard of those in a while. Enron is back. It only take, the markets have got a limited memory. Memories of Enron fade, SPVs are back. Okay, so this is the size of private credit markets, and you've seen there's been a huge growth in private lending. Now, so Jim Chanos is saying that the recent cases illustrate excess in private credit, lax lending standards, and are a harbinger of future problems. And this is the price of trickler bonds. And you can see all came out of the blue. So the bonds were priced at 100 and then they weren't. This is the price of the various securitizations, and the AAA rated down 10%, the bottom rated, that's a fall of 90%. Very painful. This is First Brands. Similar story. It came out of nowhere. Bang, gone. Okay, so Tricolor were funding themselves through asset-backed securities. What are they? So, so what Tricolor are doing is that they loan money to people who want to buy cars, and those loans they then bundle up into securities which they sell to investors, to banks, insurance companies, etc. And by selling those loans, they turn illiquid loans into a liquid security which they get money for, which funds Tricolor and allows them to do more loans.
And as we know from subprime mortgages, they also spread the risk very nicely.
Yes. You cut up the asset-backed securities into tranches. You have a AAA tranche and then riskier tranches, as illustrated by this chart. And this is exactly what banks were doing with mortgages in the great financial crisis. When we look at the mechanics of how you create an asset-backed security, you need lots of different parties involved. So you need trustees to hold the collateral and enforce covenants, investment bankers to structure the loans into securities and market them, auditors and underwriters to verify and certify the assumptions involved in creating the asset-backed securities, servicers to keep records of the underlying loans and to channel the payments to the relative securities, and rating agencies to assess and monitor the performance of the underlying and of the individual securities. And you remember that in the great financial crisis, the rating agencies came in for a lot of criticism for conflict of interest and giving too high a rating to these securities. So this is how securitization works. Please pause, have a read. The bottom line is you turn portfolio of loans into a series of asset-backed securities, different of different credit risk, which you sell to insurance companies. So Tricolor provided loans to subprime borrowers backed by cars, and was largely exposed to the Hispanic community. Only 32% of Tricolor's customers had a credit score, i.e. 68% had none.
Most did not have a driving license.
I know. Yeah. I mean, most did not have a driving license. I mean, frankly, this is pretty basic, isn't it? I mean, how can you loan money to people who aren't legally allowed to drive a car? But so they fitted these cars with trackers, and one of the accusations leveled at Tricolor is essentially they were charging a high down payment, lending money to illegal immigrants, and when they couldn't pay, they'd come round and get the car back very quickly. So it was a sort of scam on desperate people after a car. Anyway, the company quadrupled in size over the past decade, had 1.4 billion in debt outstanding from 14 bond offerings, and I really like this. It was being touted by the investment banks for its ESG credentials based on its role as a CDFI, a community development financial institution, lending to Hispanic borrowers. Highest tranches of its CDO were AAA rated. So the problem with Tricolor was, and this is amazing actually, that it was the primary servicer of its own asset-backed securities, i.e., it was responsible for record keeping, billing, collections, and channeling payments to the relevant securities. And when Jim Chanos is talking about excess in private credit, I mean, this is a very good example. You know, they did not require a third party to service these loans. And so therefore, Tricolor basically double pledged. That's the allegation. So when you think, you know, you own a tranche A, but actually they pledged the same loans to tranches B, C, and D. So when this all came out, collapse. Okay, now let's move on to First Brands. And the First Brands fraud revolves around supply chain financing. And yes, we have been here before as well. Think Greensill. So factoring involves the seller getting immediate payment for their goods from the buyer by selling the invoices to a funder. So normally when you sell goods there's a delay before you get your money. You issue an invoice and it's 3 months before the buyer will actually pay you. What you can do is factor those invoices by selling them to a funder, and in return for those invoices, the funder gives you the money right now minus a discount. So the funder makes money by then going to the buyer and getting the full value of the invoice a bit later. This is a very old form of trade financing. Now, this affects the capital structure of a company, depending on how the factoring is done and whether it's counted as trade financing or factoring. So in non-recourse factoring, which is the most common form of contract, the funder buys the supplier's invoice at a discount and assumes ownership of those invoices from the buyer, i.e., it takes on the credit risk of the buyer. It has no recourse to the seller. So when you look at this capital structure, all those receipts no longer belong to the supplier. Okay, this has gone outside the capital structure.
I think just a point of clarification is that let's say that this business is doing £1 million turnover a month,
yeah,
and it's factoring all of that £1 million, and the payment, to take Keith's example, the payment period is 3 months. Then at any given time, the supplier will have £3 million of outstanding invoices that have been factored. So the debt would be notionally £3 million. And so that it's a revolving facility. So in the scenario I've put together, it remains constant at that level, but yes, the actual amounts due are reinitiated to new customers and paid off by old customers.
Yeah. Thank you, Richard. The complication is that a bankruptcy court may recharacterize the sale of the assets as a secured loan, in which case you end up in the same position as option 2, which is a with recourse factoring. So in which case, if the buyer fails to pay, the funder can then go after the supplier for the unpaid invoice. So in that case, the funder would end up as a creditor to the business in the case of a bankruptcy. So in option one, it's simply taken the invoices and it's not a creditor in the case of the bankruptcy. In the second case, it is, and it ends up somewhere in the debt seniority list. Now, there's also reverse factoring, and First Brands did both. Okay, so it's an auto parts supplier and it has its own suppliers. So in reverse factoring, when you buy something from one of your suppliers, you approach a funder to provide immediate payment to your supplier, promising to pay them later. And so First Brands was doing factoring, i.e., it was selling its invoices to the funder to get money first, and reverse factoring in that it was approaching funders to pay its own invoices. So one of the things that First Brands is accused of doing is double financing. So pledging the same invoices to multiple funders. When we talk about excess in private credit, one thing that should have been a red flag to lenders is that the founder of First Brands, Patrick James, had been sued previously for fraud and misrepresentation. During the Great Financial Crisis, several of his companies failed, and James was sued for fraud by two lenders who alleged that misrepresentations and omissions related to their accounts receivable had amplified their losses. Sound familiar? Both cases were dismissed after settlements were reached, but you might think that that would raise eyebrows and cause potential lenders to be very thorough. But what First Brands is alleged to have done is to have disguised the size of its debts through the use of off-balance sheet special purpose vehicles that disguised about $4 billion worth of debt. So the company reported debts of 5.6 billion, but the true figure is now estimated to be somewhere between 10 and 50. 50 seems extraordinary, but certainly I think we're looking at 10. Creditors to First Brands include at least 517 collateralized loan obligations. UBS is estimated to have faced losses of up to 500 million. And we talk about investment banks. So Jefferies was trying to market a 6 billion loan to refinance First Brands debts as late as last month. And essentially the bankruptcy was precipitated when clients demanded more information and they had to do some digging. Not good. So bottom line, private credit market has grown very rapidly in recent years, and these two bankruptcy cases do appear to indicate weak lending standards. In the case of one, you were talking about the founder having previous allegations for fraud in just this sort of thing, frankly. And the other one, you're talking about the company itself administering its own asset-backed securities and being in charge of the paperwork, which is not very good. First Brands was audited by BDO, a big accountancy firms. So now, do we think this is a harbinger of more systemic problems in the private credit market? Not sure. This is fraud, and fraud's always quite idiosyncratic. So what do you think, Richard?
think it's very interesting what's going on. I think there's one of the things that I find staggering. I will answer your question, possibly not directly, is that this First Brands had 12 billion. The number I got was $12 billion of debt, and it was a car part supplier.
Yeah.
Now, what on earth was anybody doing lending $12 billion or any part of a total of $12 billion to a car part supplier? It's just extraordinary. And to me, it shows that there is a lack of understanding of scale in the people who initiate these things.
But the point is, Rich, they didn't know that total debts were 12 billion. They all thought that, they thought total debts were 5.6.
Okay, fair enough. 5.6 is still an awful lot. But,
it is, yeah.
And then secondly, there seems to be a sort of a misunderstanding generally, not amongst people who are reasonably well informed, but there's a misunderstanding that private credit is something different, and the banks is different to the banks, but all credit is created by banks. So anything goes wrong in any credit market anywhere, it goes back to the banks, because the banks are the only institutions that are capable of creating credit. I think probably that these were, as you point out, Keith, these are alleged to be fraudulent, but I think that the fact that so much money is being lent to such dodgy institutions anyway is an indicator that the lending standards have been very lax, that the banks haven't really been monitoring them, and that there's probably a great deal more of this stuff hiding, which is going to come out, particularly if the economy, as and when the economy slows down. As Warren Buffett said, it's only when the tide goes out you can see who's swimming naked. And in this case, the tide going out is the economy slowing down. So I think there's a lot of it out there, and the banks are probably very exposed to it.
Well, when you say banks are the only ones who can create credit, the only ones who can create credit out of thin air, the private lenders, if they, let's say, they issue bonds and get funding from private, from institutions, and then they lend that out to companies. That's the kind of private credit route. So they're not creating money out of thin air.
That is true, Keith. You're quite right. Yeah. So that puts things like pension funds and insurance companies on the hook, doesn't it?
Yeah, that's right.
Yeah.
The other thing to note is that Trickler basically failed because the ICE raids and the slowdown in the economy put particular pressure on Hispanic communities. And so subprime borrowers in the US are in trouble. So this chart shows that late balances are rising. There's stress on the US consumer, but, the size of subprime is nowhere near as big as it was in the GFC, particularly for mortgages. Mortgages, there's no problem now. The banks have learned their lesson. Auto loans was never as big a problem, but, it's still there.
So we're now going to have a look at Argentina. So President Javier Milei, who's been in the news a lot recently, he was elected president of Argentina in November 2023, a libertarian economist, and it came against a backdrop of 211% annual inflation, a recession, and a poverty rate of over 40%. So a bit of a mess. So his policies were austerity, so cutting state spending, freezing infrastructure projects, merging government ministries, public sector wage and pension freezes below the rate of inflation, laying off thousands of government workers. And the consequence of that was that in 2024, the Argentinian government ran a fiscal surplus for the first time since 2012. On the monetary and currency policy front, there was an immediate devaluation of the peso to basically align the official and black market exchange rates. And they then instigated a policy of exchange rate stability where the currency is subject to a crawling peg. So it could vary within bands that rose by 1% per month. He stopped money printing. So the central bank could not create new pesos to fund government or pay interest on its own debts. All sounds very sensible, doesn't it?
Mm.
The central bank was not granted independence. Currency controls were not removed, and $40 billion was borrowed from the IMF to bolster Argentina's exchange reserves. He then went on to deregulate and liberalize the markets using presidential decrees to enact wide-ranging deregulation, labor laws, eliminating hundreds of regulations, liberalizing rental law. He has attempted to privatize many state-owned companies, although he's been frustrated. And he has attempted to promote inward investment with tax concessions, foreign trade benefits for major projects, particularly in the energy and mining sectors, where Argentina has significant resources. So initially successful. So this is showing the reduction in government spending as a percentage of GDP. He took it from a peak of 38% down to around about 34% now.
Yeah, but that's a big cut, in a very short space of time. That's a big cut.
Yeah. And there's the positive budget balance that we talked about a little earlier, 1.8% primary balance. And that's what happened to inflation. And it's now come down to 35% or so.
Yeah. Yeah, but still, it kept on rising. He devalued the peso, so inflation went through the roof.
Yeah.
It's coming down again, but, not great.
And it's leveling off a bit, isn't it? So the cumulative effect of inflation over recent years has been a massive rise in the price index. It's at 10,000. So it starts at 0 and goes to 10,000.
Yeah. Well, I think it starts at 1 and goes towards 10,000.
Yeah. It's a log scale, isn't it? So anyway, a huge loss of purchasing power in the peso.
Yeah, no, it's not a log scale. It's a linear scale, Richard, but still.
I see. Right. GDP growth has recovered 6.3% year on year in quarter two.
Yeah.
Rachel Reeves, eat your heart out.
Yeah. But, not a good couple of years, but, some recovery.
Its external debt to GDP has been stable at 43%, having come down from 70%. Its debt to GDP ratio is down from 157%, which basically is the death spiral, to 83% in 2024. Yeah,
this is the Weimar debt dynamics. If you can get inflation up, you just basically erode the real value of your domestic debts.
Yeah. And unemployment has fallen from about 13% to 7.5%. So the stock market has done extremely well, although it's falling off quite quickly now. And because of currency depreciation, US dollar returns less impressive, but still very good, 117% in 2024.
Yeah, still really good.
Yeah.
So, I mean, initially, he was doing what he said. So, you've got GDP growth improving, unemployment coming down, budget being cut.
Mm-hmm.
Stock market loves it.
But the reforms were incomplete, so capital controls remain. The central bank is not independent. And Milei viewed the central bank as a primary cause of Argentina's inflation, supposed to abolish it. The problem with that is it's actually the politicians who require of the central bank that it print money.
Yeah.
And so actually the fault lies with the politicians, not with the central bank. I'm slightly contradicting myself here, I know that. And because the exchange rate was not free floating and was subject to the peg, the exchange rate appreciated very strongly in the first half of 2024, making Argentina uncompetitive, sucking in imports, hurting the economy, and starving of the income it needed to repay its foreign debts.
So he's attempting to get inflation down, but real interest rates were hugely negative during the period.
Yeah.
So how are you going to control the money supply unless you control credit in a sort of socialist way by deciding who's going to get it and passing it out to your cronies? But his fundamental problem was that he was trying to keep inflation down, not through monetary means, but through keeping the exchange rate artificially high. And that starves you of capital that you need to pay your foreign debts.
So this is a graph of the Argentina overnight repo rate, interest rate, versus the inflation rate. As Keith says, they're hugely negative real rates.
Just shockingly negative. That is just amazingly bad.
Yeah.
You're talking about real negative interest rates of like 200%. It's like
the annihilation of savings.
Yeah, the annihilation of savings. And this is not when we say he's coming in trying to impose rational economic policy. This is like exhibit number one, and him not actually doing what he says.
He sort of did half the job, didn't he?
Yeah.
And the crawling band. This is showing the banding of the exchange rate for the peso.
Yeah. The point is, Richard, it's rising by 1% a month. Yeah. But then he's got inflation, which is falling from 200%. So, it's like this is nowhere near the band is not rising anywhere near as much as it should, given you have inflation, 100%, 50%, whatever.
Yeah, I mean, it should be rising at, let's say, 10% a month, shouldn't it, initially, to try and match the rate of inflation.
Yeah, just float it. Why, if you try and impose, as the Britain knows, by imposing in the ERM, if you have hard limits to your, the level of your exchange rate, if you run out of FX reserves, the markets will test them, and then you will end up in devaluation. Just better to let it float. And it hasn't got that much FX reserves. Does it really want to spend those reserves defending, an artificially high exchange rate?
No, indeed. So that just shows the US dollar versus the Argentine peso from when Milei came in.
Yeah. So massive devaluation.
Yeah.
Yeah.
So inflation is still 34%, much higher than the rate of currency depreciation, and that's what's led to the decline in competitive and the sucking of imports and the making exports too expensive.
Yeah, and so this chart is last 25 years, but if you look at it just last year, you see that the peso appreciated in real terms by 50% between January and over the course of the last year.
I mean, either you don't interfere or you interfere, but you can't half interfere.
Precisely. A mess.
Yeah. I mean, if you completely interfere, it's also a mess, but you can't fix it by half interfering.
Yeah.
So its current account deficit in the first quarter of 2025 is $5.2 billion.
Yeah. So
basically reverting to what it was before he came into power.
Yeah. So when he had devalued, he made the peso competitive and he fixed things. And then,
he unfixed them.
Yeah, he unfixed them.
So the IMF comes to the rescue again in April 2025 and offers an extended funding facility. So which is going to take the exposure of Argentina to a new high of 40 billion, isn't it?
Billion. These are special drawing rights, so I'm not exactly sure how the SDRs convert into dollars, but it's like something like 55% of all IMF lending goes to Argentina.
And poverty has jumped. It never really came down, in fact, did it? It came down a little bit.
Well, fiscal austerity is not going to improve the poverty rate. You're hoping that you know,
Well, of course, the idea would be that the private sector economy would take off.
yeah, exactly.
But it didn't. So now they're back in a crisis. And that's his sister, who's the General Secretary of the Presidency of the Argentine nation, there by her own endeavours, I'm sure.
Yeah, precisely.
So the Karina Millet corruption scandal linked to audios reveal she allegedly taking bribes for the purchase of medicines.
Yeah.
Taking 3% for each contract. So basically, he came to power promising to tackle corruption.
Yeah.
And his sister has been indulging in it in a big way. And the Argentinian public is not impressed.
And he's defended his sister and hasn't fired her. So, he's revealed to be a hypocrite, frankly.
So now the Argentina electorate has changed their mind and the approval rating has dropped to 42%. Still a lot higher than Keir Starmer's. The disapproval rate has shot up.
That's true.
I don't think it's fair that Keir Starmer has such a low approval rating.
I agree.
So on the 7th of September, regional elections and the opposition beat the coalition party. So it's all fallen apart, really, hasn't it?
Yeah, that's right.
It's sort of a protracted Liz Truss moment.
Yeah, so 40% of the whole Argentinian electorate is in Buenos Aires.
Wow.
And, Millei's coalition was well beaten, which suggests he's going to lose the next election. So
that obviously caused a crisis of confidence in the stability of the government, leading to a sell-off in Argentine bonds, which has recovered a bit, but they went up to 15%. They're now down to 12.5%.
Yeah.
And the US is considering opening a swap line, I guess, to try and keep Argentina stable.
Yeah. Well, they are political ideologues, aren't they? So right-wing libertarians.
Yeah.
So the US the bond yields only came down when the US intervened.
So the latest is that the Milei has temporarily suspended export taxes on many key crops, presumably at the behest of the US. So soybean farmers will benefit from it. Corn and wheat farmers will benefit from it significantly. And these will continue until the end of October.
Yeah.
7 million. But this is all reactive stuff, isn't it? This is not part of a coherent plan now. This is just him firefighting.
Yeah, exactly. But the thing is, that will get farmers to sell their crops and get in some FX.
So this is a classic problem of emerging market debt. It needs to earn US dollars to pay interest on outstanding debt, and it can't do so if it doesn't devalue the peso, which will create inflation. So it is in this emerging market debt trap. So it has 95 billion of dollar and euro denominated debt with net reserves of 6 billion. And it's got 44 billion of debt repayments to make in the next 2 years, basically. And it won't be able to do it.
No, won't be able to do it.
So the US has offered this 20 billion swap line, which will help a little bit. And the US Treasury might buy Argentine bonds. I'm sure there'll be a price to pay for that.
Yeah. Well, I haven't heard anything since the original announcement, frankly.
No. So, it's not good, is it? It's, US support is conditional and won't prevent a solvency crisis given the amount that's owed. Milei is losing support. He's introduced a degree of family corruption when he was on an anti-corruption ticket. He went off half-cocked with the reform of the economy, and he overvalued the peso by 30% according to the FT. So it's just going to have to go around this cycle again, isn't it? It's going to have to start again, basically.
Yeah. So, but basically, I just don't see any way out of this. Essentially, it's an economic crisis, but once again, it's really a political one.
It is,
because it looks like it's a busted flush now, and the Peronists are going to come back in, and they're going to go back to their socialist ways.
I mean, fundamentally, all economic crises are political crises, aren't they? They're a result of political mismanagement.
Yeah. So the US support is just too little. It's like, and it won't change the politics.
It's a sticking plaster.
Yeah. So, yeah. expect more Argentine shenanigans, and let's go back to being in the beginning of the 20th century. They're one of the five richest countries in the world.
It was a fabulous country, wasn't it?
Yeah, and now it's
And
basket case.
then your communists got their hands in it.
Yeah, and it's going to go back to being a basket case.
Yeah.
Thank you, Richard. Very quickly, just on technology, I saw this during the week.
Hello. She's waving at me, Keith.
Yeah, she is. She's available on lots of sites, Richard.
So she's been created by AI, has she?
She has, and we've talked about this before, how real films involve loads of crew and caterers, etc.
Mm.
You just generate an AI model. They can do all the stunts without getting injured. They're not going to have a hissy fit, etc., etc.
No.
Frankly, it's coming.
It is.
Yeah.
It is indeed. And you can have AI girlfriends now, can't you? I mean, slightly more.
Going back to our talk about Gen Z last week, I think lots of them do have them.
More explicit version of Tilly Norwood.
Yeah, exactly. And finally, on to good news. So while we talk about, AI and social media and all that stuff, I found this very encouraging in an old manish sort of way, in that, all obviously modern life is shit. And I wish that people would get off social media and actually talk to each other down the pub. Well, here we go. Social media may have peaked, particularly biggest declines in the young. So
fantastic.
This week I saw my nephews and I asked both of them whether they used Facebook. No, Facebook is for old people. So there you go.
Yeah. Mark Zuckerberg, be careful.
Yeah. So even old people have been slow to adopt social media. I have to say I'm not on Facebook or anything like that.
No.
Yeah. But anyway. And concluding comments, well, more the same, frankly. Markets grind higher. The AI bubble continues to inflate precious metals. Congratulations, Richard. Continues to have an absolutely extraordinary year. The US economy is being supported by AI. And,
Yeah.
At some stage that will come to an end, but I've been saying that for a while. In the meantime, I'm going on holiday. So, enjoy the autumn, people. I hope you're all making money to compensate for the poor English weather. And we'll see you in a couple of weeks. In the meantime, thank you for watching. Please press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.